back. Yeah. Hello and welcome to how leading institutions are using ETFs, best practices for success. I'm Paul Britt, a senior ETF analyst here at ETF.com. Thanks very much for joining us today. Before we get started, let's take care of a couple housekeeping items. First, this webinar has been accepted by SEMA for 1 CE credit. Attendees will receive an email for instructions following the presentation. Second, the deck will be available online following the presentation. Third, please do go ahead and enter any questions that you have into the WebEx dialog box. I believe it's the Q&A dialog box that should be at the lower right-hand side of your screen. And we'll try and get to as many of your questions as possible at the end. You've got a lot of ground to cover today in this webinar, but I want to be sure that I leave you with some key takeaways. So I'll lead with them here and I'll repeat them again at the end. First, the institution's increasing use of ETFs for strategic applications and for exposures beyond just plain vanilla equity. Second, ETF growth is in a virtuous cycle. Third, to understand the create-redeem process is to understand ETFs. And last, ETFs differ greatly from mutual funds and from one another. This last point highlights the importance of ETF evaluation. As a footnote, I'll generally refer to all exchange-traded products as ETFs, and we'll certainly touch more on the differences in structures in a moment. We'll start by describing how institutions are using ETFs and the outlook for institutional use going forward. Next, we'll take a step back to talk about overall growth drivers and benefits of ETFs, often citing how creation and redemption process is inseparable and totally connected with the benefits in these growth drivers. Then we'll discuss the risks that come with ETFs, because things aren't all as rosy as they may seem at the outset. And we'll end with a comprehensive way to evaluate ETFs. Let's talk now about trends in institutional participation in ETFs. The slides in this section are based largely on separate surveys and analysis done by Greenwich Associates and by Russell Investments. The broad trends here are unambiguous. Overall adoption is up, strategic usage is up, fixed income and smart beta adoption is also up. Institutions were first drawn to ETFs for tactical and short-term applications. These include interim beta and manager transitions, essentially ways to keep investor dollars at work in times of transition. These uses continue today with tactical exposure adjustment and overlays among them. What's newer, however, is the increased use of strategic applications of ETFs. In fact, core applications now ranks at the top of all applications among institutional funds, pension funds, endowments, and foundations who use ETFs. Risk management and liquidity can also be considered as strategic uses of ETFs. As you can see as a footnote or as an aside, as you can see in the survey response, and as with others that I'll show here, responders could choose multiple answers. Consistent with greater strategic usage, holding periods are lengthening. The dominant time horizon now exceeds 2 years among institutional funds who use ETFs. In short, institutions are broadening their strategic use while maintaining the tactical use that brought them to the space in the first place. Fixed income is a big part of the ETF growth story for institutions. Among pension funds, endowments, and foundations who use ETFs, more than half use ETFs for domestic fixed income, and roughly a quarter do so for international fixed income. Part of the institutional interest in bond ETFs is driven by some weakness in the underlying bond market itself. In other words, institutions may feel that they have more convenient or better access to the market via ETFs than in the underlying market. The reasons for this are twofold. First, a decreased inventory of bonds in traditional venues, that is, banks. And secondly, a lower overall trading volume of the underlying bonds. Fixed income ETF adoption is likely also buoyed by an increase in the product breadth and depth of ETF product offerings. This includes the increased availability of products like bullet maturity ETFs that support bond ladder applications using diversified and liquid ETFs in lieu of individual bonds, as well as increased depth in emerging market debt products. Bear with me one moment. Technical challenge here. Still, within the availability of asset classes, it is equities that dominate here. And just as the fixed income ETF opportunity set is broadening, so is equity. Within institutional ETF users, 1 in 3 is employing non-cap weighted, non-traditional exposure, smart beta exposure, in other words. A Russell investment survey of institutional asset owners in North America and in Europe found a similar adoption rate of smart beta strategies, that is roughly 1 in 3. One survey question focused on why institutions evaluated smart beta strategies in the first place. In other words, what were they looking for? Leading the answer, the promise of lower risk and/or higher returns. These two broad reasons led over other factors like diversification or exposure to a specific risk factor or cost factor. So this part of it speaks to the why of smart beta adoption by institutions. Regarding the which of smart beta, in other words, which strategy were institutions that is, reaching for, we see that fundamental and low vol strategies are preferred over quality, risk parity, and others among institutional asset owners in the US, at least in this survey. This question focused on the adoption of smart beta strategies, however, rather than the smart beta ETFs in particular. So again, this question with respect to preferences was vehicle agnostic. However, when we dive deeper into smart beta vehicles, we can see that ETFs lead the way for tactical access to smart beta strategies quite clearly, but that ETFs have far to go regarding strategic adoption of smart beta. My own view is that these preferences are dynamic. Regarding strategic versus tactical, smart beta ETFs may become more attractive as strategic vehicles as the product set broadens and becomes even more viable with respect to assets and liquidity, and as institutions become more comfortable with ETFs for strategic exposure in general. I'd also view the preferences for particular strategies themselves to be dynamic. Let's take a step back now to talk about all ETFs, not just smart beta and fixed income ETFs, and the criteria that institutions view as important when selecting an ETF. The common thread among the top 3 entries listed here is cost. Specifically, it's the total cost of ownership, with trading as one key component and expense ratio and tracking error as references for holding costs. We'll talk more about drivers of ETF costs and ETF liquidity in a moment. In addition, several other bullet points on this list here speak to the overall brand of the issuer as being important to institutions, namely the fund company, the breadth of offerings, the total AUM, and the service component. We'll definitely talk a whole lot more about ETF selection and evaluation in a moment. So what's the outlook going forward for institutions and ETFs? Well, it's more growth, supported by a virtuous cycle of broader ETF growth. The exponential growth in the ETF ecosystem facilitates greater adoption by institutions. Broad growth drives total costs down and increases the viable investment set. The ETF fee wars that brought some of these low fees down and it's so low in the first place continue. As a matter of fact, BlackRock will fire another salvo tomorrow as it slashes fees on core exposure ETFs. ETF adoptions by institutions, as well as by advisors and retail, further improves ETF liquidity, which in turn is cited as a key selection criteria for ETFs by institutions. Secondly, the trends towards fixed income and smart beta show that institutions no longer put ETFs into a plain vanilla pigeonhole. This in turn supports increased adoption. As another facet of the growth story, institutions and asset managers have shown a willingness to have an ETF made to meet their needs. While these products are custom built, they are available to all once they are on the marketplace. I've got 4 examples here that I'll just briefly touch on. The first is an Arizona pension fund that teamed with BlackRock to deliver a trio of very low-cost, actively managed ETFs. Secondly, Fisher Investments worked with multiple banks to bring a suite of levered exposure products in an ETN wrapper, some seeded with hundreds of millions in assets. 2 more launched today, as a matter of fact. Fisher likely worked with multiple banks to spread out the counterparty risk that's associated with ETNs, and we'll talk more about that shortly. Riverfront Group, an asset manager and RIA, felt like the best wrapper for their core fixed income strategy was an ETF, not an SMA or mutual fund. Similarly, Vidant and Lattice Strategies developed a product to meet the needs of a large RIA and chose to deliver it in ETF form. In addition, a new class of ETFs not yet approved by the SEC could provide a middle ground between active mutual funds that remained well entrenched and ETFs. The so-called non-transparent product set could lure more big-name managers into the ETF fold. Institutions that prefer a particular manager could then access that manager in an ETF wrapper rather than in a mutual fund or an SMA. I've talked before about the virtuous cycle of growth here, and I think by now we've probably all seen a chart like this. The ETF growth that we see here is really powered by all 3 groups of users: institutional, advisor, and retail. The ETF benefits that appeal to one type of user might not be as useful to another, but together they help to fuel the AUM growth that's pictured here, as well as an accompanying increase in liquidity. The growth story, however, is not one of a rising tide lifting all boats. Instead, ETFs are growing fast and mutual funds are not. It's really that simple. The numbers over the past 5 years, 81 billion out of mutual funds and 770 billion into ETFs, are especially impressive given that mutual fund assets still outstrip ETF assets some 10 to 1. So what's driving this growth? It boils down to 5 key benefits that do so: lower costs, tax efficiency, intraday trading, transparency, access to just about anything. These ETF growth drivers are intertwined with the mechanics of how ETFs themselves work. So I'll take the opportunity to talk about both the drivers and the mechanics at the same time. The first of these growth drivers is low cost, and this is probably the most obvious one and most frequently cited as well. Headline fees for ETFs are far lower than those of mutual funds. Expressed as a part of the total AUM, ETFs offer savings in the billions of dollars each year versus mutual funds. Now, it's true that institutions in particular can often access strategies more cheaply, that is, than other types of the investing public. Still, ETF fees are tough to beat for the larger investing public, And really, for some of these plain vanilla strategies, once you're talking to a handful of basis points, it's a race towards zero. So do ETF issuers just like to give their products away out of the kindness of their heart or in some aim to just win market share? We think that's not really what's going on. In fact, ETFs have a structural cost advantages that allows issuers to charge less and still make a buck. So let's take a quick moment to look at how shares of a mutual fund are created versus how shares of an ETF are created. Let's say sometime during the day, you decide to buy $10,000 worth of shares in a mutual fund. You place the buy order either directly with the fund company or through your brokerage account, and the money is transferred from you to the fund company. At 4 p.m. Eastern Time, the mutual fund has some serious work to do. It takes your money, it calculates how many shares your $10,000 will buy, it writes down who you are, sends you your shares, mails you a prospectus, staffs a phone bank to answer your questions, and more. The next morning, the manager of the fund must take your $10,000 and go into the market and buy the underlying securities, incurring any trading costs or slippage along the way. If you decide to sell, the process reverses itself. An ETF, however, works differently. When you want to buy shares of an ETF, you enter in a buy order just like you would a regular stock. Somewhere on the other side, another investor decides to sell you those shares. Now, notice what didn't happen. First, you didn't wait until 4 p.m. to have your order processed. You can make the trade at 10 a.m., 12:30, or 3:30, whenever you want. But more important, notice that the ETF company itself isn't mentioned anywhere on this slide at all. At this point, the ETF company doesn't even know you exist, and in some ways, they don't really need to. They don't care. And the reason is they don't have to send you the money, they don't have to write down who you are or how many shares you own or send you a prospectus, and there are no fund managers going into the marketplace and buying the securities. This structure cuts out a whole layer of cost. The ETF issuers themselves need the underlying basket of stocks, however, to match the ETF shares that are being bought and sold in the secondary market. And that's where the ETF creation and redemption process comes in, a process that contributes to the low cost that we just outlined and to tax efficiency. Capital gains distributions in ETF, especially equity ETFs, are a rarity. Now, it's true that many institutional investors are non-taxable environments, but still, the distributions from mutual funds are regular cash flows that must be reinvested or otherwise dealt with. But really, more importantly, it's the creation and redemption process that drives ETF's tax efficiency and lies at the heart of what makes an ETF and increases its appeal to the broader investing public. In the mutual fund world, large sellers of a fund can create a taxable event for the shareholders that remain. That's because the fund manager must sell the underlying securities to come up with the cash to return to the departing investor. Any gains on the underlying securities are distributed pro rata to all shareholders. That's not so in the ETF world. The exiting ETF investor simply sells her shares in the secondary market. In the case of ETF redemptions, the issuer can pass on low basis stocks to an authorized participant with no tax implications at the fund level. Let's break down the create-redeem process just a bit more to understand just how this works. Maybe the quickest way to do this is to picture the initial creation of ETF shares when the fund is first launched. So there's several launches today and tomorrow, so you can picture this happening almost as we speak. Market participants called authorized participants, or APs, are authorized to create shares of an ETF. Before an ETF launches, one of these APs will enter into an agreement to create a basket of ETF shares, perhaps 100,000 shares, for example, priced at $25 each, or $25 million. The AP will go into the market and buy the individual securities that the ETF wants to hold. If this is an S&P 500 ETF, for instance, the AP will buy up the individual stocks in the S&P 500 and then ship those to the ETF company in exchange for shares of the ETF. The ETF gets all the shares in IBM and Microsoft and Cisco, etc., everything that it needs, and the AP in return gets shares of the ETF that it can trade in the market. This process on the redeem side also works in reverse. If the AP wants to redeem shares of an ETF to the issuer, it can buy up the 50 or 100,000 shares of the ETF in the public market and then turn the ETF shares in to the ETF issuer. In exchange, the ETF company will provide the AP with shares of the underlying securities based on the fair value of the ETF. Crucially, the ETF issuer can rid itself of any low basis stocks by putting them in the security basket that it hands back to the AP. This feature, combined with any banked losses that the issuer may have, makes cap gains payouts so rare, especially on the equity side. The AP, meanwhile, does not inherit the issuer's cost basis of the securities. That's how ETFs work. Now, retail investors, frankly, they don't need to know any of this is going on necessarily. But in my view, it's critical for institutional investors to understand how all of this works because the create-redeem mechanism drives the core benefits of ETFs, low cost and tax efficiency that we just spoke of, and one more, and that is intraday trading. ETFs are bought and sold all day just like stocks. They can be shorted or have options written on them. Accurate intraday pricing of the ETF makes this possible. By accurate, we mean here the market price of the ETF matches its value as represented by intraday NAV or INAV. And that is the value that all ETF issuers must publish every 15 seconds of the trading day. INAV shows the value of the underlying portfolio that the ETF holds. This slide here compares the market price of SPY in blue with its INAV, and it's shown as returns over a few days. The point is that the lines here are indistinguishable, meaning that premiums and discounts are negligible. As for how it works, we'd return one last time to the create-redeem process and the role of APs. Authorized participants make their money by arbitraging away price differences between the ETF's market price and its underlying basket of securities. This arbitrage process that's baked into the creation and redemption system keeps the ETF share price in line with its fair market value. Consider what happens if there's a huge buy order with a crush of investors trying to buy up shares of a particular ETF. As with any security, the price of the ETF will go up. When people are piling into something, that's going to drive the price up. And for some period of time, the price of the ETF shares may rise to a premium above its true fair value. In this example here, the ETF share price rises 10 cents above its fair value to 25.10. So what does the AP do in this case? Well, the first thing that she does is capitalizes on the premium, selling the ETF shares at their inflated price. Next, she'll hedge her exposure in some fashion. And eventually, if needed, to create shares in the ETFs, she will buy up the underlying holdings or some other hedge priced at fair value. That is, she's short the ETF and needs to be long the underlying to maintain her hedge position. The beauty of this system is that the selling pressure on the ETF shares drives the price back towards its fair value, while the buying pressure on the underlying securities helps lift the shares. And with this, the ETF snaps back to alignment with the ETF share price. Meanwhile, the AP has made a nice arbitrage profit, 10 cents a share in this case, before cost. And of course, the same thing happens in reverse if there's selling pressure. The ETF can drop below fair value temporarily, a discount in other words, in which case the AP can jump in and buy shares of the ETF at their discounted value, hedging herself by selling the underlying securities which she can get at fair value by redeeming the shares of the ETF at the end of the day, and thus lock in her arbitrage profit. So either way, the activity pushes the ETF share price back in line with that of its underlying basket of securities, and the ETF keeps trading on its merry way. Creation and redemption process works in either direction. Now, there are important wrinkles and exceptions to this, and we'll touch on these in a moment when we talk about risks. But in general, this is how an ETF works, and the in-kind create-redeem mechanism that helps keep ETF share prices closely in line with NAV. I'm going to touch briefly on just a few more of these growth drivers, and then we'll move on. The fourth of these is the transparency that we value in ETFs. Mutual funds might disclose their portfolios once a quarter, and when they do so, it's often on a lagged basis, a week or so behind sometimes. Now, in contrast, most ETF issuers make their daily holdings available to everyone on their websites. There are a few that don't, including one very large one, Vanguard, which publishes positions in its ETFs monthly and on a lagged basis, more in tune with the mutual fund style. But really, that is the key exception, that and a few other issuers. In the main, most ETF issuers do disclose holdings on a daily basis. Interestingly, this includes active funds, which, as contrary to your expectation, are actually required to disclose their daily positions as opposed to funds that track an index. Now, the last growth driver here is access. ETFs are growing in number and not just in AUM. Within the 1,600 or so funds, it's true that equity ETFs dominate. Still, the equity offerings are far from homogeneous and include some of the smart beta style funds that we spoke about earlier. And we indicated that some of these smart beta funds have found adoption by institutions, as well as broad adoption by advisors and retail investors. Some of these funds have really taken off with respect to AUM. And this broadening also holds true within the fixed income space. The real point here is that all ETFs offer broad, rather ETFs as a whole offer broad and narrow exposures across a variety of asset classes. So we've just taken a moment and we've walked through a bunch of the growth drivers, and I've shown you a hockey stick style chart with the assets going up and everything looks quite rosy. And there's a lot to be happy about here with this growth story. But as with anything else, especially in the investing world, there are risks and watch-outs within the ETF space, some of which can be fairly subtle and take, frankly, longer to understand, in my view, than some of the easier to grasp benefits. Now, many of these include risks that are associated with the ETF structures that are needed to access the different asset classes that I described earlier, and also risks that are associated with the realities of trading. First, we're going to talk about the risks that are associated with ETF structures. As I mentioned at the outset, I've been referring to all ETFs structures as ETFs, but in reality, there's quite a variety here. Most ETFs do come in what I would call a plain vanilla wrapper, and that's a wrapper that's also shared by mutual funds, namely the open-ended 1940 Act fund. The open-ended part of it simply means that it's a continuous offer of shares, unlike, say, a closed-end fund, for example. In my view, open-ended ETFs can probably be viewed as the plainest type of ETF structure, but still 40 Act ETFs face limitations on what they hold, which explains the existence of some of these other structures. Exchange-traded notes, for example, or ETNs, are actually debt instruments that are backed solely by the credit of the issuing bank. That is, investors have no claim on the assets that are tracked by the fund, or by the note, as the case may be here. They're often the first vehicle of choice, however, for assets that don't easily fit into a 40 Act wrapper. Next, unit investment trusts, which are a legacy structure. They're few in number, but mighty in assets. The UIT structures include SPY, which is the world's largest ETF. A UIT is a very subtle structural risk is that it can't reinvest dividend proceeds of its underlying securities in between distribution periods, which creates a slight cash drag. Grantor trusts typically hold physical commodities and currency assets. You can think of it as gold in a vault or, say, Swiss francs in a bank somewhere. Commodity pools hold futures. They differ most perhaps in their tax implications for the investors, namely that they're marked to market annually with taxes reported on a K-1 form rather than, say, a 1099. Now, this fact may matter little to some institutions, but I would note that the maximum tax rates are affected both by the legal structures that we've outlined here and by the nature of the underlying asset. The two things are intertwined. If you want more on this, please do see the updated 2014 tax guide to ETPs that's on our website. But for now, really the main takeaway for this slide is that ETFs don't all come in the same wrapper, and the wrappers do matter. Among the structural risk borne by ETF investors, ETN counterparty risk is probably the greatest. The risk here is that the bank that's issuing the notes, whether it's Barclays, Credit Suisse, Deutsche Bank, etc., doesn't make good on its promise to deliver your capital back to you plus returns on the underlying index that the ETN is tracking. At ETF.com, we monitor this risk using credit default swap rates on the banks. And our general view is that the likelihood of failure is low, but the key thing here is that it is all of your capital in returns that are at risk, which is why this ETN risk is at the relatively high end of the spectrum of the risks on the left-hand side of this slide. Lesser risks include the counterparty risk in funds using swaps and OTC derivatives. There are a handful of ETFs that rely solely on swaps for their entire exposure. Some other funds will rely on over-the-counter derivatives just to access certain portions of their exposure. But our view is that since most of the swaps are marked to market or netted regularly in some fashion, the risk really amounts to a few days' worth of returns on the upside rather than your entire principal. And that's because they're backed by collateral. Many ETF issuers also lend underlying securities and pass on some or all of the net proceeds to the fund. The securities that are loaned out are typically collateralized at 102% at minimum. That's typically spelled out in the prospectus. And so we see this risk as quite small, but still greater than zero. A more subtle risk in ETNs that isn't strictly counterparty risk is that of hedging their exposure. Some ETNs with extremely volatile underlines have a time to close for creations because the risk desk of bank don't feel comfortable with the positions. And while that's entirely prudent, anytime an ETF or ETN, any type of structure closes for creations, it will create pricing distortions in the market price of the product relative to its fair value. Still, the graphic on this slide is meant to convey that all of the risks mentioned here really pale next to the risk of the ETF's underlying exposure, that is, market risk. So the idea here is that, yes, there are some risks, but to keep them in perspective. Now, in addition to these structural risks, ETFs bear tracking risk, namely the ability for the ETF to deliver the returns of its underlying index. Now, it's here and not the expense ratio that true holding costs are found. That is, holding costs are relative to the returns of the underlying index. And the expense ratios of a fund are definitely an important ingredient, but they're far from the only ingredient with respect to tracking risk. Tracking differences compare the fund's NAV returns to that of its index on a total return basis. Basic tracking difference is straightforward to measure if you have clean data. Now, that sounds simple, but it's really not given the breadth of ETF products. For example, some issuers of ex-US funds will publish a fair value estimate of NAV to help keep the share price, or the NAV that is, in line with the market share price of the fund. Now, why would they do this? The upside is that it makes trading more intuitive by accounting for such things as time differences in the underlying market versus the market where the ETF shares themselves are trading. But this approach has its trade-offs too, namely tracking differences. In short, fair value estimates will distort tracking differences relative to the index. Similarly, a fund issuer or an indexer might rely on a different time of day to strike the currency value for some of their international securities. Optimization is a big part of it too. Optimization can either help or hurt tracking. A small cap emerging market ETF or a broad bond fund, for example, may hold just a fraction of the securities named in the underlying index. Pricing discrepancies can also distort results as fund issuers and indexers recognize corporate actions and special payouts at different times. Again, tracking differences and variability ultimately tell the true story of holding costs far more completely than does the headline expense ratio. We spoke before about trading, and unlike mutual funds, ETFs trade all day in the secondary market. Trading costs are incurred for either vehicle, meaning for mutual funds and for ETFs, when an investor wants to get out. But just who incurs these trading costs? In an ETF, trading costs are generally outside the fund and are borne by the investor doing the trading. In a mutual fund, trading costs are inside the fund typically and are borne by all investors collectively. Now, some ETFs are liquid enough to handle very large institutional size trades comfortably within their on-screen liquidity. Most don't, however, and rely on liquidity providers and APs, in some cases the issuers themselves, to help institutional investors move large blocks of shares effectively. The bottom line is that institutions may not need to transact in the secondary market and may in fact bear costs either less than or greater than those suggested by the on-screen inside spreads shown here. Institutions, in fact, much more so than advisors and retail investors, can access underlying liquidity when it helps them, or they can access the ETF's secondary liquidity when that's the better path. Institutions trading in size might not directly bear bid and ask spread costs shown on the previous slide, but they still face costs of their own, whether it's creation fees, the costs associated with the spreads of the underlying securities, liquidity provider costs, and per share costs, to name a few. And there's one more too that's sometimes overlooked: market impact. In short, the create-redeem process that we spent so much time talking about earlier can adversely move the prices of the underlying securities. At ETF.com, we measure this risk by unpacking a creation unit of the stocks and assessing the aggregate percent of typical daily volume in the underlying market. And the right-hand column in the snapshot is a weighted average percent of underlying market volume for one creation unit of execution in the 4 emerging market funds. Note that this significant variation between funds here, even within the same emerging market equity space. I'd also note as an aside that Bloomberg's implied liquidity measure which was developed by David Abner over at WisdomTree, uses a similar concept. Bloomberg's implied liquidity looks at the impact of a creation unit on the underlying basket, but it does so and returns a number which represents the maximum amount that can be traded while being more than 25% of the daily volume of any single underlying constituent. We spoke earlier about how the creation and redemption process keeps the market price of the fund in line with its fair value. But at times, large premiums and discounts do occur, and this is especially true in funds where underlying liquidity is a challenge, like the high-yield muni bond ETF shown on this screen. The outflows in this chart coincide with large discounts, a period where the market price of the ETF is significantly less than NAV. Now, either one of two things is happening. Either A, the underlying high-yield muni bonds are correctly priced as reflected in their NAV, and the ETF is truly trading at a discount. Or, as I believe was the case here, the ETF is actually the more liquid vehicle, really much more liquid than the underlying, and in fact, the ETF is the accurate price discovery vehicle for the aggregate underlying. In other words, that the premium, or the discount rather shown here, isn't really a discount at all, but really a true representation of the value at the time. So what's the takeaway here? Well, really the takeaway is that part of the risks that's associated with premiums and discounts is understanding when they matter, when to look at them, when to know that they matter, and when to discard them, and trying to understand the reasons that drive them. Sometimes the ETF truly is at fault, and other times the liquidity of the underlying basket or other factors like market hours overlap are at play. ETFs have real risks to go along with the benefits that we hear so much about. And while ETFs differ from mutual funds, as I've just described, it's my strong feeling that ETFs differ from each other, ETF to ETF that is, just as much, if not more so. And this is what makes ETF selection and evaluation so hugely challenging. At ETF.com, we meet these challenges head-on with an analytics tool built for ETFs from the ground up. We maintain the cleanest ETF data available and feed it into an objective, rules-based, quantitative system for evaluating ETFs. We use a three-pronged approach to this evaluation, and I'll walk through it briefly right now, and I'll highlight those areas of our evaluation that are particularly pertinent to institutional investors. The first of these three vectors of analysis is what we call efficiency, which you can simply think of as how well a fund delivers on its core promise to investors, delivers the core promise of its index. By that I mean, if you buy an MSCI Emerging Markets ETF, for example, how well does that ETF really deliver the returns of the MSCI Emerging Markets Index? What costs and risks do I need to contend with aside from the risks of the index itself? We look at a lot of things in efficiency, but chief among these are expenses, which includes the potential for higher expenses, and also at tracking error. Statistical measures of tracking, goodness of fit, beta, standard deviation, etc., power our scoring. But we also display an intuitive 12-month rolling difference summary, which makes tracking numbers much more intuitive and makes them directly comparable to the expense ratio. We look at the risks that flow from an ETF structure as well. If it's a UIT, for instance, we'll account for the dividend drag caused by its inability to reinvest dividends intra-period, as we described earlier. Also for ETNs, we'll measure the counterparty risk, look at the counterparty, and assess those CDS rates as I mentioned before. And if the ETF makes significant long-term use of over-the-counter derivatives to gain exposure, we'll look at the treatment of the collateral that's used for those OTC derivatives. We'll also look carefully at securities lending and balance the risks taken with the rewards that accrue to the fund holder. Rounding out our efficiency analysis, fund closure risk. This is a big one, and it's based on 6 quantitative metrics that look beyond AUM to consider, among other things, an issuer's health and the ETF's rank in the competitive landscape. Because along with the some hugely liquid funds that I outlined before, there are a lot of funds at the other end of the liquidity distribution, if you will, and AUM distributions that really don't have any money in them and don't trade very well and are in danger of being closed in our view. Secondly, on this slide, transparency is also important to us, and what that means to us is many things, including the disclosure of holdings, but also the methodology, the disclosure of current documents, and upcoming ex-dividend dates. We measure cap gains payouts and consider the max tax rates on share sales and on distributions. Those are some of the things that go into the efficiency part of our evaluation. Tradability is the second vector of our analysis, and here we look at some of the classic measures of fund liquidity, really secondary liquidity, such as spreads and volume. This is looking at the liquidity of the ETF shares themselves. And for example, our spread metric snapshots all ETFs every minute of the trading day to get a true fair measure of liquidity, of secondary liquidity. We also look at some of the stats that are used by liquidity providers and APs so we can understand the true costs and risks to trade these funds. We care about creation units, for example, because the more likely an AP is able to amass a creation unit's worth of shares, the more quickly she can shed the risk and the carry costs associated with them, and therefore the cheaper the fund will be to trade. Likewise, the easier it is to hedge the risks of holding a partial basket of securities or to execute a basket proxy trade quickly, the more willing the APs will be to keep arbitrage activities going strong that help keep the ETF markets tight. Rounding out our tradability analysis, we assess the potential for price impact, as I discussed before, by measuring the underlying volume key metric. Folks, we had some audio problems, but I think I'm back now. I'll briefly touch on this slide and then wrap up the few remaining, and then we'll open it up for your questions. Thank you. So rounding out the tradability part of our analysis, we look at the underlying volume per unit, which is a key metric for institutions trading in size. Also, we'll look at creation unit costs. These are fees that issuers charge typically at a minimum to transact in the creation units. Sometimes institutions can't see these fees necessarily directly, but they would typically be rolled somewhere into the cost of transaction at the cost at the creation and redemption level. We also look at impediments to creation, because when a fund closes for creation, systemic premiums and discounts will typically follow, as I outlined before. We also display premium and discount information. We do so prominently on our site, but actually we don't score from it due to some of the subtleties that I outlined earlier. The last part of our analysis is what we call fit, and that's maybe the most controversial, if you will, in that we hold up the ETF not to its own index as we do in efficiency, but rather to a neutral benchmark. Now, for benchmarks, we choose them very carefully. We're using a rules-based comprehensive set of indexes, and we have a preference for discrete index families. We want to make clear here that our benchmark is not what we feel to be the best investment, but rather the best benchmark for a particular market segment. And by market segment, I mean something like small cap value or Germany total market or muni bonds, for example. So the point is that we're not making a market call here in any way, but rather trying to select a benchmark that's neutral and then compare a set of funds to that benchmark. On the equity side, we'll select a market cap weighted equity. For fixed income, we'll look at market value weighted and selected. For commodities, we'll look at front month futures. In other words, we're looking for the most neutral plain exposure that we can get that's wrapped into an index for use as benchmark. Now, we've benchmarked hundreds of market segments that we've designated, and while few may agree with every choice that we've made, a common benchmark allows related funds to be fairly compared head-to-head. The comparison of the fund to our benchmark has two parts. First, there's a performance analysis that's based on regressions and deviations of log daily returns of the fund's total NAV to that of the benchmark. And second, we look at holdings analysis that's asset class appropriate. So for example, in equity, we'll look at the sector and country biases of the fund relative to our benchmark. some market cap tilts, style leanings, holdings overlap, again, trying to assess how well the fund fits that benchmark. But for fixed income, for example, we'll look at duration and distributions of securities by credit rating and by maturity buckets. Really, there's way more to go into in FIT that I'm going to take time with here. But the idea is that we're making it asset class appropriate and doing a FIT analysis based on both holdings and returns. Now, all of the metrics that I just outlined here, efficiency, tradability, and FIT, get rolled up into quantitative scores 0 through 100. Efficiency and tradability are further combined into letter grades A through F. Thus, the most compact score is a letter grade summarizing can I own it and can I trade it? In other words, the efficiency and tradability part. And the numeric score is simply how well the fund fits a neutral benchmark. So that almost does it here, and I really thank you for your time today. And I do want to get to a question or two if I can, but before I do so, I just wanted to summarize those key takeaways one more time here. Specifically, that institutions increasingly use ETFs for strategic applications and for exposure beyond just plain vanilla equity. Second, that the ETF growth cycle is a virtuous cycle that in turn informs more growth down the line through support of, or through increased viability, that is, of more AUM and more liquidity. Third, as you can tell, I dwelt heavily on the create-redeem process, but that really is at the heart of ETFs, and once you understand that, you understand ETFs in my view. And lastly, yes, we spent a lot of time drawing differences between ETFs and mutual funds, that it's important to recognize that ETFs are very different from one another in so many different ways, and in my view, it's just wrong to lump them all together into one homogeneous whole. So let me pause here and see if I can gather up any questions here that may be around. Bear with me one moment. I see one coming through here with respect to a question on some of the low vol and fundamental strategies that I outlined about midway through. And that's a good question. It has to do with, hey, what are some of the funds that are available in this particular space, and how do they differ? So just very briefly, I'll touch on maybe one or two here. Within the low vol space, there are really two that leap to mind. One is SPLV, and the other is USMV. The chief differences among them, SPLV is a portfolio of low volatility stocks, whereas USMV is chosen with all of the stocks chosen to produce a portfolio that itself is low volatility. In addition, USMV has further constraints imposed on it to keep it from varying too much from market-like exposure with respect to sectors and some of the style biases. Now, while the underlying methodology under these two funds is really quite different, they both differ really radically from our benchmark, as you can see on our fund reports if you go there, and they both do, in fact, deliver low beta to a neutral benchmark, even though their approaches are quite different. On the fundamental side, we're talking about funds like PRF, which is uses a Rafi methodology. And the key factor there is that the securities are selected in weighting really without regard to the market price of the stock at all, but rather by looking at the economic footprint, if you will, of the company in question. So really some very different structures there. So with that, I will wrap things up. Thank you very much. Let me see if there's just one last question here. I see a question coming through here with respect to studies or anecdotal reports regarding institutional use of existing active ETFs. I really haven't. The active space is really quite small in the ETF world. I don't know what it is as a percent of AUM, but it's probably under 1%, I would guess. Active ETFs so far within the ETF world are really confined or most prominent within the fixed income space with funds like BOND. garnering a lot of attention. And really, last time I looked at active ETFs, really of the top 10 active, I think 9 or something were fixed income. That doesn't make them unworthy, but I'm just pointing out that it is a pretty narrow space. So short answer is no. So with that, I will wrap things up. Thank you very much for listening today. I will point out for further information, please do visit ETF.com for independent rules-based analytics. And also note that ETF data products are available. Please reach out to sales@etf.com if you have any interest in that. And lastly, if you have any follow-up questions for me, go ahead and send them along at pbritt@etf.com. Thanks very much for joining us today.